In today's video, we are breaking down a powerful interview with Tom Lee, the head of research and chief investment officer at Fundstrat Capital, where he lays out a warning that every investor needs to hear right now. Tom Lee says the markets are being held hostage by Washington, and he explains why so much of the volatility we are seeing has less to do with the economy and more to do with political uncertainty, policy decisions, and the looming question of who will lead the Federal Reserve next. In this interview, Tom Lee dives into the Fed chair decision, the sudden pullback in gold and silver, and what this ongoing market rotation really means for stocks, crypto, and risk assets as a whole. He breaks down the real reason markets feel so unstable right now and why gold, stocks, and crypto have all been moving in ways that are confusing a lot of investors. I am going to play the clip of Tom Lee on CNBC first, and right after that, I will give you my own reaction and breakdown of exactly what he said and what it means for your portfolio. Then, I will take it a step further and walk you through my in-depth analysis of 3 of the best tech stocks to buy right now based on everything happening in the market. Go ahead and hit the like button, share it with someone who needs to hear this, and drop your thoughts in the comments. Subscribe to the channel so you do not miss the next important investing update. Now, let's hear what Tom Lee has to say.
Joining us now is Tom Lee, Fundstrat head of research. I'm not going to say that that you didn't call this, Tom, because it was the beginning of the year you were talking about, did you use the word speed bumps or volatility, or I don't know what it was, but you also said that a lot of it could be based on things coming out of Washington, that the market was going to be held hostage to that to some extent. Is this worse than you expected, or pretty much what you were thinking?
Well, and parts of it have been much worse. Like, you know how I think the crypto market has taken it much worse than we expected.
Why?
I think part of it is the crypto industry doesn't have any leverage right now. It sort of delevered in October. And now when we have gold and silver doing so well, especially at the start of the year, that created FOMO. And that was like a vortex sucking all risk appetite towards the precious metals trade. So I think crypto has suffered from that on a price basis at a time when the fundamentals have been good. You know, it's been a contrast. I think the broader economy is actually in good shape. So to me, the turmoil here is kind of what you said. There's a lot of uncertainty because of Washington picking winners and losers. And some of this could be the new Fed pick. But I'm also kind of heartened. I think gold and silver taking a breather is actually a good thing. A
breather? I mean, 80 on silver, that's not breathing yet. It's like, I don't know what that is. You do point out that the consensus now is for the GOP to lose the House, and that is not necessarily a negative for the markets for the future, because it's already consensus.
Yeah, I think it's consensus. It might actually be a positive surprise if the GOP keeps the House.
If that were to happen.
If that were to happen, but that's a big if. I think one of the things that we're seeing, of course, this year is the White House is deliberately picking more winners and losers early, I think, because of the midterms. In other words, their agenda is front-end loaded. I think that has caused some turmoil in markets.
Even if it was Hassett, or I don't know who the markets would have liked, but you think no matter who it is, that the market tests the new chairman of the Fed when he's announced, or she is announced.
We saw that with Fed Chair Yellen and Fed Chair Powell, that in the early days the market tests them, whether it's their resolve around policy or rates. So I think the confirmation process creates a little uncertainty, and then I think the first FOMC meeting. So I think that's why the middle of the year could be quite bumpy.
Then you'd point out some things maybe to keep everyone a little bit grounded. Stocks were up the first 5 days of this year. Stocks are up 1% in January this year. Since 1950, that's happened about half, a little bit less, 36 times. That's 76 years, and the S&P was up 18% on average after a start like that. But I thought you said it. Someone recently said they don't even pay attention. I guess it was David Bonds. They don't even pay attention to what happens in January. That indicator doesn't work. It's like the Super Bowl indicator. It's had its time, and you think it does? Historically, this is important.
Yeah, it's very telling. I mean, there's 36 times when it happened just exactly as you described. 33 to 36 times the market was up the average gain's 18%. If you look at the non-36 instances, the other 34 or so, the market on average is down 5% for the year. So it makes a huge difference to do well in the first week and the first month.
A lot of this, obviously, the giveth and taketh away. AI went almost not like gold and silver, but kind of, asymptotic in a lot of those stocks, trillions of dollars of valuation. So that's going to be tough. That could be a headwind. Is that just, regresses, or we use mean regression or reverse?
Yeah, mean reverts, yeah.
Which do you like better? Reverse?
I could see both working.
I know. All right, so that could be a problem. So crypto doesn't have leverage right now. Is it going to go to the levels that you have talked about in the past still, or let's say 75,000 for Bitcoin? Is that a place where people would say, okay, I'm ready to buy, or is 40,000 a place where people say, I'm ready to buy?
Okay. I'm going to say something it sounds a little contrarian, but okay. Tom DeMark is our advisor at Bitmine in terms of crypto. He's been since mid-November saying Bitcoin would go to 77 and Ethereum at 2,400. So he's been waiting for what he calls time and price to align. This weekend, he believes we reached that alignment. So all the pieces are in place for crypto to be bottoming right now because we're getting the level and enough time has passed. So I think as long as crypto fundamentals are good, which is the case, Ethereum active addresses is going parabolic right now, and activity. Part of it is, of course, Wall Street is building up digital assets and converging those businesses. If that's the case, then crypto prices should follow.
What we are reacting to here is Tom Lee talking at the very start of February, with markets already feeling shaky, futures weaker, and a lot of anxiety creeping back in. Right away, the interviewer reminds us that Tom had warned about this kind of turbulence earlier in the year. He did not say markets were going to crash, but he did say there would be speed bumps and volatility, especially tied to political uncertainty coming out of Washington. And that framing is important because Tom is not surprised by volatility itself. What surprised him was where the pain showed up the most. One of the first things Tom admits is that parts of this sell-off were actually worse than he expected, especially in crypto. And I agree with him here. A lot of people assumed that crypto would be one of the stronger risk assets coming into the year, especially after how well it performed late last year. Instead, crypto took it on the chin, and Tom gives a really interesting explanation for why. He points out that crypto does not have leverage working in its favor right now. In simple terms, the big speculative fuel already burned earlier. A lot of the excitement and positioning came in October, so when January rolled around and gold and silver started ripping higher, all that fear of missing out capital shifted away from crypto and into precious metals. It became this vortex, as Tom described it, sucking risk appetite out of crypto and into gold and silver. This part really stood out to me because it explains something a lot of investors struggle with emotionally. Sometimes an asset can have good fundamentals and still go down, simply because attention and capital are flowing somewhere else. That does not mean the story is broken, it just means markets are rotating. And that is exactly what Tom is arguing here. Crypto prices suffered even though the fundamentals remained strong, which is a frustrating but very real part of investing. What is also interesting is that Tom does not think the broader economy is actually in bad shape. That is an important distinction. He separates market turmoil from economic weakness. In his view, a lot of what we are seeing is uncertainty driven by Washington picking winners and losers, combined with speculation around a new Federal Reserve chair. That kind of uncertainty creates hesitation, not necessarily recession. Personally, I agree with that take. Markets hate uncertainty more than bad news. When policy feels unpredictable, investors pull back, reduce risk, and wait. That does not mean everything is collapsing, it just means confidence is temporarily shaken. Tom then makes a comment that I think many people overlooked. He says that gold and silver taking a breather is actually a good thing. At first that sounds odd, especially when silver in particular still looked very strong. But what he is really saying is that extreme one-sided moves are unhealthy. When too much capital crowds into one trade, it creates instability across markets. A pause in gold and silver could allow risk assets like equities and crypto to stabilize. The conversation then shifts into politics, specifically the expectation that the GOP could lose the House. Tom points out that this outcome is already consensus, and when something is consensus, it is often already priced into markets. That is a key concept many investors forget. Markets move on surprises, not expectations. In fact, Tom suggests that if the GOP were to hold the House, that would actually be a positive surprise for markets, not because of ideology, but because uncertainty would be reduced. Whether you agree politically or not, markets tend to like gridlock when it limits aggressive policy swings. I personally think this is a very realistic way to look at politics as an investor. You do not need to like the outcome, you just need to understand how expectations are positioned. Tom also explains that the White House appears to be front-loading its agenda ahead of the midterms. That means more aggressive policy actions earlier, rather than later. And that front-loaded approach creates turbulence because markets have to reprice winners and losers quickly. Again, this is not necessarily bearish long-term, but it absolutely creates short-term volatility. Then comes the discussion about the Federal Reserve and the new chair. Tom reminds us that markets always test a new Fed chair. We saw it with Janet Yellen. We saw it with Jerome Powell. Investors push back, question resolve, and look for clues on rates and policy direction. The confirmation process and the first FOMC meeting alone can introduce a lot of uncertainty. This is why Tom believes the middle of the year could be especially bumpy. I think that is a fair warning. Too many people assume volatility only happens at the beginning of the year. In reality, the summer months are often where the real tests occur. To balance out all this caution, Tom then brings up some historical context that I actually think is very powerful. He points out that stocks were up in the first 5 days of the year and finished January up about 1%. Historically, when that has happened since 1950, the market has gone on to post strong full-year returns, averaging around 18%. Now, the interviewer pushes back and says some people think January indicators are outdated, almost like the Super Bowl indicator. Tom strongly disagrees. He says the data is very telling. Out of 36 similar historical instances, the market finished up in 33 of them. And in the years where this signal did not happen, markets were down on average. Whether you believe in this indicator or not, I personally think it matters more than people want to admit. No indicator is perfect, but when probabilities skew that heavily, it is at least worth respecting. The conversation then touches on AI stocks and the massive valuations they reached. Trillions of dollars in market cap were created very quickly. Tom acknowledges that this could become a headwind, whether through mean reversion or regression. Basically, prices got ahead of themselves, and now reality needs to catch up. I think this is one of the most important lessons for retail investors right now. Even the best themes can get overheated. That does not mean AI is over. It just means expectations need to cool off before the next leg higher. Finally, the discussion returns to crypto, and this is where Tom makes a very contrarian statement. He references Tom DeMark, who has been calling for Bitcoin to bottom around 77,000 and Ethereum around 2,400. According to DeMark, time and price have now aligned, meaning the conditions are in place for a crypto bottom. Tom Lee supports this idea by pointing to fundamentals, especially Ethereum activity, which he says is going parabolic. Active addresses are surging, signaling real usage rather than speculation. This is where I want to add my own perspective. I think this is one of those moments where sentiment and fundamentals are completely disconnected. Crypto feels weak, headlines are negative, and confidence is low. Historically, those are the exact conditions where bottoms tend to form. That does not mean we rip higher immediately, but it does suggest downside may be more limited than people fear. Overall, my takeaway from this interview is that Tom Lee is not dismissing volatility, but he is also not panicking. He sees political uncertainty, Fed transitions, and crowded trades creating short-term noise, while underlying economic and market fundamentals remain relatively healthy. Whether you agree with all his targets or not, the bigger message is about patience, context, and understanding where fear is coming from. And for long-term investors, that is often where the real opportunity starts. Now, let's dive into the 3 best tech stocks to buy now and how to invest in them. The first company on this list is Microsoft, ticker symbol MSFT. Microsoft is one of those rare companies that sits at the foundation of the modern digital economy. Almost everything we do in business today runs through some version of Microsoft's ecosystem, whether people realize it or not. From operating systems and productivity software to cloud infrastructure and enterprise security, Microsoft has embedded itself so deeply into global workflows that switching away is often more painful than staying. What makes Microsoft truly powerful is not just what it sells, but how sticky its products are. Once a company adopts Microsoft tools, they rarely leave. That creates predictable recurring revenue and extremely high customer retention. This is one of the strongest moats in all of technology. At the center of Microsoft's growth story right now is its cloud platform, Azure. Azure continues to gain share as businesses move workloads away from on-premise servers and into the cloud. What separates Azure from competitors is its tight integration with existing Microsoft software that enterprises already use every day. That creates a seamless transition for companies migrating to the cloud. Another major growth driver is artificial intelligence. Microsoft has positioned itself as one of the biggest winners of the AI revolution by embedding AI directly into products people already rely on. Instead of forcing customers to adopt entirely new tools, Microsoft enhances Word, Excel, Outlook, Teams, and developer platforms with AI capabilities that boost productivity. This approach lowers adoption friction and accelerates monetization. Microsoft also benefits from diversification. If one segment slows down, another often picks up the slack. Cloud, productivity software, gaming, enterprise services, and AI infrastructure all contribute to a balanced revenue mix. This diversification is a big reason Microsoft remains resilient even during economic slowdowns. From a financial standpoint, Microsoft continues to generate enormous free cash flow, which gives it flexibility to invest aggressively while also rewarding shareholders. The company consistently returns capital through dividends and share buybacks, reinforcing its reputation as a shareholder-friendly business. In my view, Microsoft represents the ideal long-term tech investment. It combines innovation with discipline, it grows without taking reckless risks, and it adapts to new technological shifts without abandoning what already works. For investors looking to build wealth steadily over time, Microsoft remains one of the most reliable pillars in the market. Before we move on to the next company, I want to quickly tell you about today's sponsor. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the second company on this list. The second stock is Apple, ticker symbol AAPL. Apple is often misunderstood as just a hardware company, but that view misses the bigger picture. Apple is one of the most powerful consumer ecosystems ever created. It is a platform company disguised as a product company. Apple's true strength lies in its ecosystem. Once a user owns an iPhone, they are far more likely to buy an Apple Watch, AirPods, a MacBook, and subscribe to Apple services. Everything works together seamlessly, creating a user experience that competitors struggle to replicate. This ecosystem locks in customers and drives long-term recurring revenue. One of the most important shifts in Apple's business over the past several years has been the growth of its services segment. Services include the App Store, Apple Music, iCloud, Apple TV Plus, Apple Pay, and more. This segment generates high-margin revenue and continues to grow even when hardware sales fluctuate. Apple's pricing power is another key advantage. Despite premium pricing, demand for Apple products remains strong. The brand commands trust, loyalty, and status. That allows Apple to protect margins even during inflationary periods when costs rise. From a strategic standpoint, Apple is also extremely disciplined. The company does not rush into trends just for the sake of being first. Instead, it waits, refines, and enters markets when it can deliver a polished experience. This approach has helped Apple avoid many costly mistakes that other tech companies have made chasing hype. Apple is also quietly positioning itself for the next phase of computing. Whether it is augmented reality, spatial computing, or deeper AI integration across devices, Apple has the advantage of controlling both hardware and software. That vertical integration gives it a level of optimization that few competitors can match. Financially, Apple remains a cash-generating machine. The company produces massive operating cash flow and continues to return capital to shareholders through dividends and buybacks. Its balance sheet strength provides resilience during market downturns and flexibility for future innovation. My personal take is that Apple is not about explosive growth anymore. It is about consistency, durability, and compounding. Apple is the kind of stock that quietly builds wealth while investors sleep. It may not always be the most exciting name in the market, but it is one of the most dependable. Now let's move to the third and final company on this list. The third stock is Nvidia, ticker symbol NVDA. Nvidia sits at the heart of the artificial intelligence revolution. If AI is the engine driving the future of technology, Nvidia is supplying the fuel. Its chips power data centers, AI models, autonomous systems, and advanced computing workloads across the globe. What sets Nvidia apart is its dominance in high-performance graphics processing units used for AI training and inference. These chips are incredibly complex, expensive to design, and difficult to manufacture at scale. That creates a massive barrier to entry for competitors. Nvidia has also built a powerful software ecosystem around its hardware. Developers rely on Nvidia's platforms and tools to build AI applications. This software layer increases switching costs and strengthens Nvidia's competitive moat. Once companies build on Nvidia's stack, moving away becomes costly and time-consuming. Demand for Nvidia's products has surged as companies race to deploy AI across industries. From cloud providers to enterprises to research institutions, the need for AI computing power continues to grow rapidly. Nvidia benefits directly from this trend as one of the primary suppliers of AI infrastructure. Another key advantage is Nvidia's ability to innovate quickly. The company consistently releases new architectures that improve performance and efficiency. This rapid innovation cycle keeps Nvidia ahead of competitors and reinforces its leadership position. However, Nvidia is not without risk. Expectations are high, and valuation reflects strong growth assumptions. Any slowdown in AI spending or increased competition could lead to volatility. That said, Nvidia's execution so far has been exceptional, and its strategic positioning remains unmatched. In my opinion, Nvidia represents a higher risk, higher reward opportunity compared to Microsoft and Apple. It is more sensitive to market sentiment, but it also offers exposure to one of the most transformative technological shifts of our time. For investors with a long-term mindset and tolerance for volatility, Nvidia can play a powerful role in a diversified portfolio. Now that we have covered all three stocks, I want to share one important thought about how to invest in them. These companies are not meant to be traded frequently. They are designed to be owned. The real power of Microsoft, Apple, and Nvidia comes from time, not timing. Trying to buy and sell around short-term market noise often leads to missed gains and unnecessary stress. A smart approach is to invest gradually, using strategies like dollar cost averaging. This reduces the emotional pressure of market swings and allows investors to build positions over time. It also aligns well with the long-term nature of these businesses. Diversification matters too. While these are all tech companies, they operate in different segments with different risk profiles. Combining them can help balance growth and stability within a portfolio. Before we wrap up, here is something for those of you who want deeper insights and ongoing support. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these three companies do you believe has the strongest long-term advantage, and why? Do you prefer the stability of Microsoft, the ecosystem power of Apple, or the AI dominance of Nvidia? Drop your answer in the comments and let's discuss. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.